what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, but you've been waiting on those interest rates to drop. Well, it's happening. Stick around in this video. I'm going to tell you what to expect next. So we're continuing to see the housing market unthaw in Dallas, Texas, but we got some really good news. About a week and a half ago, interest rates dropped over 0.5% out of nowhere. So I want to talk about why. Why did this happen? Is it going to happen again? What to expect in the future? Because obviously we've all been waiting on the sidelines saying when rates are going to drop. We knew the time was coming. We just didn't know it was going to come this quick. And now it feels like a long time, but by quick, I mean like on a Monday it happened, and by Wednesday rates were, 0.75 to 0.5% lower. So always good news when rates drop. It makes things better for the clients, more affordable, easier, and it gets people off the sideline, which I'm going to talk about in a minute. But right now I want to talk about why. Basically what happens is, the Fed was projecting a rate cut. The market was kind of anticipating it, but every month they come out with a couple heavy data reports based on where the economy's at and what they're trying to project. And the two that matter the most are obviously CPI and inflation, right? So as inflation comes down and they cool it and people stop spending, they can justify cutting interest rates, because obviously if they do it before it's ready, they could push inflation back up, but obviously it's starting to cool down. That's part one. But part two, the big thing that caused the interest rates to drop were the job numbers, the unemployment numbers. So every month, based on payroll data and farming data and all these things, they get projections when they think, hey, it's going to be about here. We think this many people are going to be unemployed, laid off, whatever the case is. And they were projecting, I think, 1.4%, and it ended up being 4.5%. So that was the wow of like, oh my gosh, there's a lot more people that are losing their job and unemployed than we thought. So what happens in that scenario is that big of a miss and that many people being laid off signals to the market recession. Now, why does it signal to the market recession? Well, there's a few things about that. One, as we get towards the end of the year, publicly traded companies need to show a profit for their stockholders, all these things, right? So if they are not as profitable as they want to be, they will cut staff, which means they have less overhead, and they will make the current people that work there just do more for less. And unfortunately, with the way that things are going, that is the case. But a lot of companies had to do that. So you'll see them cut more people because they have to be profitable for the company to stay in the green, for the shareholders and stockholders to be happy. And so sometimes in order to show that positivity, they got to cut overhead, which means people lose jobs. So it was a lot more than people thought, but that was one reason why it happened. Two, some of the really good jobs numbers they reported a few months ago were part-time jobs. So they don't ever decipher, hey, this many jobs were added. That could have been a full-time job, or it could have been a part-time job in conjunction with a full-time job, but they still counted it as a job. A lot of those were only temporary, 60-day contracts or short-term things, and so a lot of the people that got those short-term jobs lost those as well. So that really fell into the pile of all the unemployment numbers, and so it gave a shock to the market that, hey, when this many people get laid off at once, something's around the corner. So anytime it screams recession, investors try to get ahead of it. This is why they saw the Dow drop, I think it was 1,000 points, maybe 2.9% in a 4-day span. So everybody has this fear to the market says I need to sell my stocks, things are going to crash, I want to get my money back before I lose it. And then of course on the rate side, people go, oh gosh, there's a recession around the corner, all this bad economic news. So it's such a weird thing for me as an American, because obviously, I want my country to do great. I want my stock portfolio to do great. However, bad economic news is actually good for interest rates. It brings them down, right? Because when there is a recession or a small crash and things start to crater, what they do is they cut interest rates quickly, because cheap interest rates and cheap money gives consumers a reason to spend. So what we saw was a little mini version of that, where job numbers popped out. They were much worse than people thought. People got scared, sold some stock, they dropped the rates down quickly, and what it did is it moved the needle dramatically in a week span of time. So, the jobs thing stinks. I think the Dow bounced back some, but sticking to interest rates, they moved from, they were starting at maybe we'll just call it roughly 7.25. They were down to 6.5. Now I think they've inched back up a tad to about 6.75 now, but this is still 0.5% better than they were. So let's run some numbers on that and say, okay, it's not where we want, but 0.5%, even after a bounce back within a week's period of time, maybe 2 weeks at the most, that's a big improvement for all the consumers. And so on a $400,000 loan, if you had 7.25 and now you're going to get 6.75, that saves you about $140 to $150 a month. So it's not chump change. It's important to pay attention to it because obviously it's starting to move in that direction. You know, I think rates will be low sixes, maybe 6.25, hopefully here in the next month or two. So if you take the difference on a $400,000 loan, 7.25, now they're probably 6.7, 6.6. When they get to 6.25, the difference in that 7.25 and 6.25 is actually $270 a month in a $400,000 loan. So that's almost $300 a month, guys. That's a lot of money, and that starts to really add up quick. One, people can justify getting back in the market again. Honestly, with lower interest rates, even though the payment is good, it brings a lot more people back into the market from an affordability standpoint and a qualification standpoint. A lot of people tiptoe on the debt to income maximum, right? They're to 49%. And 50% in theory is about the maximum that you can do. So if they're trying to buy a bigger house or the interest rate goes from 7 to 7.5 to 7.99, they're over that threshold. They do not qualify. Yes, they can put more money down. Yes, they can shrink the price, but most people don't want to. So what's happened now is with the rate drops, not only is it bringing down payments, encouraging people and getting their eyeballs back on the market, which I'll talk about at the end, what you're seeing is people are actually now able to qualify again. So this is the big sigh of relief that a lot of us have been waiting for. Now, I want everybody to remember that interest rates do not decline or increase in a straight line. Like it's not gonna always just gonna go 7.25, 7%, 6.5, 6.5, blah, blah, blah. There's bounciness, right? But the most important thing to pay attention to from what we're seeing now and my belief as of now, based on the current data, is the trend has started downward and it should continue for a long period of time, but it won't be in a straight line. I actually had a few clients and one of my agent partners reach out to me last week and said, hey man, how much more have rates came down? And I said, well, look at the data. It was actually down to 6.4. Now it's back up to 6.7. So again, it's not dramatic, but it can move a tad. And so what I mean by a straight line is, be very mindful that the interest rate decline and decreases here, but it may slam one week, bounce back the next. It may inch down a little, inch down a little, inch down, back here and there. So this is why you need a good mortgage advisor, hopefully our team, to explain to you how this works, but who understands mortgage-backed securities, who pays attention to the Treasury, who knows the bond market, who will tell you to watch the 10-year Treasury every single day on TV because that's tied to the bond market. The bond market is where mortgage-backed securities are traded and all these things. So you stay in the know. So you know the day-to-day, you know the week-to-week. And then when it comes down to on an interest rate, like when do I lock, when is it the best time? You really can only lock when you're under a contract. Now there's some exceptions to that rule, but once you get under contract, I do a contract call with every client. I always do what's called a lock strategy session. So imagine if you were buying a stock and you said, hey Brian, I'd like to buy some Amazon stock. When is the best time to buy? Well, Monday, Tuesday, Wednesday, Thursday, Friday, they're all not the same price. My job is to pay attention to the data, hedge, figure out where I think things are going to go for better or for worse, advise you, and then try to time it, right? If Amazon stock was here and you said I want to buy and it went here, I'd say buy here, then hopefully it bounces back. From an interest rate standpoint, because they're not in a straight line, and a closing on a home loan is probably 3 weeks to a month. We will pre-approve you based on where the rates are then, keep you informed until you get under contract. That could be a week, it could be 6 months, but we'll never leave you in the dark. And then once you get under contract, we'll have a contract call and say, hey, okay, cool. When we pre-approved you, it was here. Now it's actually down to here. Here's what I think we should do, because the last thing I want to do is have the rates go from 6.75 to 6.25. You get under contract, we lock, and then 2 weeks from now, rates drop down to 5.99. Now we do have what's called a float down policy, which if that happens, we can pass the savings on for you for free. That's something we'll talk about if you end up being a client, but that's a nice strategy as well. On the flip side of the coin, what we don't want to do is float the interest rate at 6.25, keeping our fingers crossed and hoping things go down, and all of a sudden there's a rally and interest rates moved the wrong way. So there is some strategy to it. We go over that in the sessions, but the most important thing I want people to take away from this is the interest rate decrease and decline appears to be here, and it appears to be here for good. This is just my prediction. We'll look back and see. Based on what I know right now, I believe that the interest rate bottom, meaning when they bottom out and flatten, and they're not going to go down anymore, is probably going to be Christmas of 25. And I think the natural interest rate, by natural, I mean, no points, all these things, which I'm going to do another video next about discount points, lower interest rate, advertised rate, all these things. But the real rate, right, that a person can qualify for is probably going to end up somewhere, I'm going to call it 5%, 5 to 5.25. You know, there's a lot of stuff in front of us for the data, but I believe between now and Christmas 25, you will see this decline up, down, but the overall trend, and I think they'll be at the bottom. So let's talk about the bad part about interest rates going down. You're like, Brian, how's it bad? I mean, rates go down, payment goes down, I win. Yes, but there is one challenge as interest rates continue to decline, and our team saw this last week. When that happens, rates drop, people qualify, and they can save $200, $300, $400 a month at the current market right now. They come off the sideline and get very active very quickly because everyone's been waiting on that. And also, rates normally don't bottom that hard that fast. So when it's a drip of like an eighth of a rate, 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 people don't feel the sense of like, gotta go. But when they drop 0.75% and hang around a half better, people come off the sideline fast because that is more than we had projected and better than we had thought. And so everyone's trying to have a grab at it. So what has happened now, our applications are up 10%. Now we have a wonderful team, a lot of great teammates. We have the capacity to handle a ton. But as a buyer, you have to be mindful of if rates hang around here and continue to trend down towards the back half of the year, you can't just wait on them to continue to trend down to get where you want to be on the payment alone, because all these other buyers out there are starting to shop for houses and go because they want the same thing that you want, which is lower rate, lower payment. And so what it will eventually do is it'll stir up some competition. That competition will increase demand, and then demand will push the prices of the house up. At the same time, it'll be harder to get a house. So there is a timing component of it, meaning like there's a good middle ground where you don't take the highest rate, you don't take the lowest. There's always something in the middle that's doable for you as a client to make sure you get a house that you want at a price that you want in an area, while saying, hey, this might be a forever home or a long-term home for 5-6 years. But remember, if you were to get that house today or tomorrow or a month from now and rates are in the sixes, if we end up getting to 5% at Christmas, you can refinance. Most people will, because they understand, hey, this mortgage loan I'm getting right now, maybe make a year's payments on it, a year and a half at the most. But what they want to do is catch that home before it blows up, meaning 20 people want to offer on it, the price goes up 20%. Buy in this range, hold on to it, make a year's worth of payments, a year and a half. When rates get to the bottom, hit refinance so you get that rate and that payment that you want. But also remember, that $400,000 house, when rates go from 6.75 or 6.5 down to 5, it will jump up 20%. So you will make $60,000, $70,000, $80,000 just in equity and appreciation based on the market conditions because of the demand. So you'll make a lot more money on the upswing as well versus waiting till the rates are at the bottom and buying that $400,000 house at $470,000. Yes, you're gonna feel good about the $499 rate and payment, but you go, well, with the extra $70,000 I'm paying on the house, it actually didn't save me a whole lot. What I should have done was bought it at $400,000, made payments, you know, an extra $200, $300 a month for a year. Yes, it cost me an extra $4,000 in payments, but now my house is worth $480,000, and I, the consumer, have made $80,000 from buying the house then versus at the end. And that's really the return on the investment piece that I'm really trying to get people to pay attention to. So we're already starting to see people come off the sideline quick. So obviously you need to get with your realtor. You need to stay connected to him or her all the time. Trust them. They know best. They live in the street. They know the area. They are working around the clock. And I will tell you, as interest rates continue to decline, it does not take much for people to get going quickly. This is my 20th year in the business. I'm also a certified planner. I've seen every market out there, from the subprime crash to the comeback to Dallas growth to COVID to rates dropping to rates spiking to all of this. I will just say Dallas is a wonderful full city. It's made it through the hardest times. It didn't take too much of a dip even when rates were up in the 8s and the 9s. The worst is past us. There's a lot of people coming here. The city is growing. People need houses. They've been waiting on rates to drop. And I believe now the time is starting. So in a market like this, the best thing that you can do is get with your agent. They know best. They're in the street 24/7. They're rocking and rolling all day, every day. They know what I know, which is, they see the entire world and market for what it is versus you as a consumer just see your actual lane. There's a lot of people out there making moves quick. And what we don't want is we don't want people to miss out on the opportunity. So many people during COVID missed out on buying a house and a low interest rate because they're like, I just can't get it. There's just too many people. And so obviously this market increase And this run's not going to be anything like that. I think it'll be about 30 or 40% of it. But we also don't want people to miss out, right? So get with your agent, get with our team, talk about the goals, get specific, come up with a plan. But as interest rates continue to decrease, demand will go up, speed will be strength, and you'll be able to capitalize on making an offer and making a smart decision when it comes to buying a house. So listen, I hope you found this interest rate video useful. If you did, do me a favor, like, comment, subscribe. If you know somebody that could benefit from this, share it with them. And if you want to have a conversation with us just about the market, interest rates, get pre-approved, should I buy now, should I buy later, do me a favor, reach out to us. Call us, email us, text us. We're always here for you. Your time is now. Until next time, stay tuned.